Hello friends, this is Vijay Bhambwani and I hope my videos are helping you become a better trader and the markets are also treating you well. In this week's video, I want to discuss how bulls are somewhat on a slippery slope. The dice in the market seems to be loaded against the bulls. Nothing really surprising here because I've been preparing you for pro-cyclical hysteresis in the markets. I've warned you about the phalanx action. After that, the pincer formation, which would box the retail guys into a corner and then pummel interest rate sensitive stocks, which is precisely what is happening. Now, in this week's video, I want to take where we left off last week and take the issue forward. On your screen right now is the weekly market roundup window, which tells you that the fall for a change was led by the broad-based Nifty 50 and the banking sector brought up the rear. I'll come to that in the later part of this video as to why this happened. The US dollar index continued to fall, which should have ideally boosted commodity prices, but it didn't. Are you really surprised? Because I've been telling you there is no commodity supercycle, and I've been telling you that since 2021. Oil and gas fell along expected lines. I told you this is a seasonal rally for the winter because gas is preferred fuel of choice for indoor heating. Winter gone, gas price down. No really need to apply any rocket science here. Crude oil has come down because OPEC has decided to open the taps and raise output, which I have been telling you they ultimately would have to. They have no choice. They all need money. Now, USD INR, which is the dollar versus the rupee, fell, which means the rupee strengthened on a week-on-week basis. The Indian 10-year benchmark bond yield fell a whopping 11 basis points, which means the bond prices went up. Why did this happen? As I told you last week, this is in anticipation of an interest rate cut on the 9th of April, which the RBI's Monetary Policy Committee or the MPC is likely to announce as per bankers' expectations. Now, the NSE market capitalization fell to 0.38%, which means the selling was fairly widespread, and market-wide position limits went up 4.69% along expected lines. Expiry is just gone and traders are now ramping up their fresh exposure, which happens every 4 weeks. The US headline indices fell across the board and provided headwinds to our market, but for which our markets would have fallen probably a whole lot less. Now, friends, I come to our in-house indicators. I start with the MWPL, and for a reason. If I was to bet my money that any indicator after the price is super critical, it would be the market-wide position limits or MWPL. And I've explained to you in this video as to why. Now, friends, look at the MWPL 20-week chart. What you are seeing is the MWPL has risen as routinely as it does after the expiry week at 30.16%. It is far higher than the first week after expiry in the prior month, which was at 29.68. So, swing traders, buy and hold traders are basically raising their exposure levels faster, and that is a good news, B, a bad news. Why good and bad? Because number one, it shows optimism. People are willing to buy at low levels. Number two, it can be a double-edged sword. The positions that you create today, you might probably want to rush and unwind should any bad news occur, which could lead to a crowded exit, as I have explained to you in a recent video, which basically talks about the possibility of a bull trap in the markets. So do take a look at that, please. Watch the MWPL daily. I upload this on my social media accounts. My contact coordinates come at the fag end of this video in the pinned comment below and the description below this video. Now, friends, I come to the stock and index futures turnover data, and what you can see is turnover fell sharply, which is routine after the expiry week because expiry is dual turnover People square up in the expiring month and reinitiate the same trade in the next month, so volume spikes up. Now, this is a routine decline and therefore nothing really much to read about. Now I come to the advanced decline ratio. Remember, this is not a day to day or week to week, but this is the average of the entire week, which is why you're seeing that the advanced decline ratio is up at 1.62 compared to the prior week's 0.74. Why is it up? Because majority of the fall came on Friday. Till Thursday, bulls were fairly cheerful, they were buying, and this nervousness will only reflect from Monday onwards. So we need to keep a very, very keen eye on the advanced decline ratio on our trading terminals. I will again upload and update this on my post-market summation every day on my social media accounts. Friends, I now come to the basis. Basis is nothing but the premium or discount enjoyed by the future as compared to spot. The more we head towards expiry, the more basis contracts, just like option premium, erodes with time decay. Now, all other factors remaining constant, lower basis means lower risk appetite, higher basis means higher risk appetite. And sure enough, basis has contracted as I had anticipated last week. I told you these lofty levels are unlikely to hold, and sure enough, you are seeing the basis fall by approximately 50% in the Nifty and more than 50%, almost 60-65% in the Bank Nifty. As long as basis does not invert, which means as long as the future is not trading below spot, which would be a clear sign of short selling, I think the markets will continue to fall at a calibrated rate. If the basis goes inverted, then you start suspecting bigger falls. Friends, I now come to our in-house indicator, the impetus, and you've enjoyed this indicator for 4 years in a row. It's exclusive, not available anywhere on the internet. Last week, we saw the impetus shoot up, and I told you that these impetus levels will not be sustained. Sure enough, impetus fell. Both the indices also fell, which means the fall was on poor momentum. There was no forceful selling across these two indices, but there was a general slip and slide rather than forceful selling. Can you really take too much comfort that the market did not sell off forcefully? No, I don't think so. Here is a video that tells you that markets can continue to fall on poor volume and low impetus for protracted periods of time. But it is, of course, a very mild positive that the impetus was low when the sell-off occurred. Now, friends, I come to our star indicator, the lift, weight, thrust, drag indicator, the LWTD. You've trusted it for 4 years and it stood the test of time. What we are seeing is that the LWTD has plunged from minus 0.02 last week to minus 0.95. Based on the LWTD itself, I had told you that I do not expect any forceful buying in the week ahead because at best I would expect short covering and not too much by way of fresh buying. Sure enough, the LWTD lived up to its expectation. Now that it's fallen to almost the period low, the low of the range, it tells me that short covering could be the only cushion that bulls can look forward to. Fresh buying, if at all any, will be very, very trickle down and minor. Friends, our indicators done. I now come to the bond market because I consider it to be the fountainhead of all money supply for other asset classes. Now on your screen right now is a weekly chart of the Indian 10-year benchmark bond yield, which has reached the lowest after January of 2022, which means bond prices have gone up. What does it indicate? Very simply put, it means bankers are buying these bonds. They are expecting that fresh bonds, if any, announced or launched or offered by the RBI will either offer the same interest rate or more likely reduced coupon rates, which is why they are buying the existing bond because they feel the yield can go lower. This is an expectation. What will finally occur will be determined on the 9th of April, max by 11:15 a.m. after the Honorable RBI Governor delivers his speech. More on banking and bonds in the fag end of this video in the segment, which I share my trading strategy for the week ahead. For now, I would say keep the powder dry. Let's wait for the RBI to reveal its hand and then take a call on what we want to do. Friends, the bond market's done. I now come to the Bank Nifty, and this index basically outperformed, relatively speaking, of course, the Nifty 50 by falling only minus 0.12%. That too, thanks to the fall on Friday. As the daily chart on your screen tells you, this index fell on 3 out of 5 trading sessions last week, and there has been a concerted effort to boost banking shares. Why? Because banking commands and banking and financial shares, I beg your pardon, together command approximately 34% weightage in the Nifty 50. And if at all anyone wants to revive the markets, no rally is possible unless banking stocks go up. Now, the price is above its monthly moving average, which itself is trending higher. So the short-term outlook is positive for now. We need to trade sustainably, especially on a closing basis above the 52,000 mark to be able to put bulls back in the driver's seat. Now let's turn to the weekly chart, which shows a small bodied bullish candle showing an inside formation, which means the body of this candle was contained within the body of the prior week's candle. That shows indecision and a lack of aggression. Now, follow-up buying invariably determines what happens next. Friends, in the week before last, this index was number 3 on the most volatile counters list as per statistical beta rankings that I maintain in-house. It fell 5 notches to number 8. Does this mean that volatility on this index has gone down? Marginally because of the narrow range, but it's more because volatility in other F&O stocks has shot up in relative comparison. So Bank Nifty's volatility appears lower. Let this not fool you into thinking, hey, I can trade volatility, I can trade the Bank Nifty more aggressively because volatility rankings have fallen. It's actually Maskirovka, which I have explained to you on my Telegram channel time and again, also in my videos. This is nothing but Maskirovka. Don't get sucked in. Now, last week, I advocated an estimated range between 53,175 on the upside and 49,950 on the downside, which held perfectly well. In the coming week, I estimate a range between 53,025 on the upside and 49,950 on the downside. Friends, in addition to this range, do also watch our daily, weekly and monthly pivots that I upload on my Telegram and WhatsApp channels. Do connect with me. My contact coordinates are below this video. And in addition to these pivots, also watch this tutorial video on how to use up pivot levels effectively so as to laser precise your entry and exit and earn a higher profit. Friends, the Bank Nifty done. I now come to the Nifty 50, which basically underperformed the Bank Nifty relatively because it fell 2.61%. And it registered falls on 4 out of 5 trading sessions last week. It also violated the 23,200 level that I have been advocating since 2 weeks in a row. Now that set the tone and tenor for weakness in the market, and the price is also below its monthly moving average, which is sideways to down, and it seems to be headed within the bearish channel, which appeared to have been breached briefly. For any possibility of stability, I'm using the word stability, please mind it here. We need a breakout above 23,200 as a prerequisite, but outright bullishness will come only above 23,800. Now that appears to be a long shot in the week ahead. Let's now turn to the weekly chart, which shows a bearish power candle, and the week prior showed a gravestone doji, which I had explained to you. It is formed when the price opens in the lower end of the weekly range, attempts to go up during the week, fails, and settles down. This shows a weakness in the bull camp and an abortive attempt to rally. If follow-up week or a day shows weakness, then bulls will be at a disadvantage, which is precisely what happened last week. So, bearish power candle is basically leading to a further possibility of declines in the week ahead. Friends, in the week before last, this index was number 9 on our most volatile counters list as per statistical beta rankings. It slipped 2 notches again because individual stock volatility in comparison rose faster. Last week, I estimated a range between 24,150 on the upside and 22,875 on the downside. I missed the support because the low it created was 22,857, which is missed by 18 points. In the coming week, I estimate a range between 23,550 on the upside and 22,275 on the downside. Friends, in addition to these ranges, please also watch our daily, weekly, monthly pivots on our free social media accounts, as also this video, which will help you laser precise your entry and exit. Friends, I now come to the last bit of statistical analysis, wherein I basically analyze the footprint of the retail trader in the 4 derivative segments in the NSE. On your screen right now is a chart which tells us that the index futures turnover contribution fell by 3 basis points. It's indicated as a blue line. Stock futures turnover contribution fell by 54 basis points, indicated as a red line. Now, why is this happening? Number one, prior week was expiry when the turnover tends to be higher, but the fact that turnover in futures, which are more capital intensive, more volatile, because the delta of futures is higher than options, it tells me that traders were basically preferring to go towards safety of options. Within the option space itself, it was index options turnover which was the sole gainer. It's indicated as a green line. Now, this is the safest instrument, the least amount of capital to trade, the lowest amount of volatility as compared to stock futures or stock options. And in the case of stock options, the turnover contribution actually fell 42 basis points, indicated as a purple line. Friends, my net reading is that risk appetite in the FNO space has fallen. I'm not really surprised. The markets have been nervous. As I have been telling you in that video, there is a great deal of nervousness. Do watch my next segment of my trading strategy next week, which is going to explain to you why the markets are nervous. Now, friends, I come to my own weekly strategy. In yesterday's video, which I made, I said bulls are possibly on headed towards a bull trap. Now, welcome to what I had forecast in the Phalanx and Pincer moves. And I had also explained to you in great detail on my Telegram channel many months ago. So you should not really be surprised. This was about to happen. It was expected to happen. Smart money was boxing retail guys into a corner and then distributing stocks. This process is called Maskirovka, and this is something that I warned you a long time ago. Now, take a look at what's coming on your screen. This is mainstream media. It is out in the open and it's happened recently. I have been warning you about interest rate sensitives for many months, and this is microfinance institutions. Of course, interest rate sensitives. These are NBFCs that lend money to people who otherwise find it difficult to get loans from scheduled commercial banks. Now, there is a possibility of higher delinquency rate in these NBFCs, which could trickle down to the scheduled commercial banks over a period of time. So this is something that the market is nervous about. And do remember, banking and finance have a weightage of approximately 34%. Now, if one third of your market is likely to get weak, tell me how you're going to have a very, very vibrant and bullish market. You basically are going to find that a challenge, which is why you see what is happening is happening. And I come time and again to interest rate sensitives or IRS stocks because they hold the key to the market weakness or bullishness, whichever way you want to look at it. Now, whenever any kind of selling or sell-off comes, it will be very basically pretty swift and pretty sizable. So you need to be basically prepared about what's coming. There is a video in which I have explained to you how you can estimate or guesstimate how a circuit limit is coming, either circuit up or circuit down, or how your stocks are about to fall. If you see that video and acclimatize yourself in advance about what to watch, you will be better prepared, and therefore chance, as they say, favors the prepared mind. As long as there is no element of surprise, the trader feels a greater degree of comfort. It's pure behavioral science. On my social media accounts, I also warned you that historical statistical correlation coefficient between various metrics that you are so used to since many, many years are about to break. Now, if you watched what happened in the Bank Nifty versus the Nifty last week, you will see what I mean. Normally, both tend to move in lockstep, but last week it was the Bank Nifty was showing a sizable amount of strength, whereas the Nifty was constantly falling. So the correlation is breaking, or at least attempting to break. I hope you have familiarized yourself and mastered the studies of Dick's token, which I have shared with you for more than 3 quarters now. I've also shared with you hyperlinks to his excellent books, which you can read for free. And many of you from my online family have told me, Vijay, this looks like Dick's token had a crystal ball 35 years ago when he wrote these books, and this is exactly how things are playing out. You don't have to spend a rupee. Read these books for free. You will basically be doing yourself and your family a big favor and keeping yourself ahead in the marketplace. Now, friends, base metals cracked very sharply in the commodity segment, which I have been telling you since 2021. As long as Latin American economies are disrupted and weak, industrial metals will remain weak over a period of time, because this is a segment that contributes over half of all industrial metals, and they are cash strapped. They will sell at whatever prices they are told to sell, and this is precisely what will happen over a period of time. So all those high-flying stories, I don't want to sound disrespectful, all those high-flying stories that you heard about copper becoming the new oil, oil going to XYZ levels, gas becoming so short that Europe will not get gas in the winter of 2025. It was nothing but narrative building. These are echo chambers that chant at various points in time in the market. You, as a real-time trader, as a real-world trader, need to understand that we traders are brain warriors. We win our wars in the market, win or lose money with our ideas. So you need to basically close your mind to many such ecos in the market. Avoid the static, that is what I mean. So now that base metal prices have come down, this will also have a bearing on stock prices of metal mining companies, which might see a little bit of volatility with a deleveraging or an unwinding bias. Can it lead to somewhat exaggerated and large price moves? I would not rule that out as well. Now, as for oil and gas, I have been telling you this is nothing but a cyclical winter-driven rally, and theta decay in the oil and gas space will be my choice of strategy. I don't need to reinvent the wheel as long as the wheel that I already have is working fine. As many traders say very, very logically, As long as something works, don't fix it. So as long as it's working, why try to dig into something which is already doing its job well? Now, what happens after the phalanx and the pincer formation? On my Telegram channel, I updated my view that I think the next area where Maskirovka will occur will be the foreign exchange market. You basically will have to compute your purchasing price parity or PPP far more proactively and far more frequently than you are doing now, which if you are a savvy trader who's traded forex and is understanding what I'm coming to, is something that by itself is a strategy. Unfortunately, we are not allowed to hedge or trade in the exchange traded platforms in India in foreign exchange since last year, since SEBI has banned forex. But like I shared a strategy on my Telegram channel, there is a quasi strategy that you can use. Please connect with me on my Telegram channel and basically see that it is the currency wars which will now be fought, and how you can basically use theta decay as a second I would say second option rather than the primary option of hedging in currencies. Friends, in my last video on why bulls might be heading for skid row or for a bull trap, I shared a hyperlink to the NSE website which gives you margin funding data every single day. You've had a couple of days, 2 days to be precise, to digest that data. Some of my online family members have reverted back to me saying we've downloaded this data and we've checked out the MTF or pledge or borrowed money in some of the shares that we are currently trading. And Vijay, it's mind blowing the way the price and the MTF is correlating. If you haven't started it already, please do so. The data comes to you free of cost. I'm very sorry why other traders are not sharing this kind of free stuff, which is the need of the hour. The retail traders need all the help that we veterans can give, because these markets are getting very, very challenging and we need to help each other to stay ahead of the crowds. And if there's anything that is available for free in the public domain, you should go out there and share it with your fellow traders. Now, friends, many of you have come out and asked me about Bullion. Bullion has fallen last week. I do understand that you might be a little concerned, but take a look at this video I made in October. If you watch it now, it'll appear to be prescient. This is nothing but common sense. Why did I say that Bullion might fall, especially if equity markets fall? Because people are so leveraged, which is why I told you about the MTF data. They borrowed money from brokers to buy shares. Now, if the mark-to-market loss comes, the loss will be bigger and the broker will be asking both for M2M as well as a haircut on the loan. All right. So, basically, people, when they are strapped for money for paying mark-to-market losses, they sell everything, bullion included. Which is why when all asset prices fall, initially you will see even bullion prices falling. This is nothing out of the ordinary. This is expected. And this is compulsion, this is fear, this is flight to safety of cash. I expect once the mark-to-market pressures are off, starting with retail, of course, institutional players on a second track will be there to buy the dips, because these are the guys who will buy in sizable enough quantities to support the market. They will let the retail get tired, bleed out and sell in panic. They will absorb all the stock and then the price might start rising again. Now, if you ask me to give you hard numbers, Vijay, at what price will gold bottom out? At what price will silver bottom out? Let me tell you upfront, I don't have a price. Why? Because it will all be proportionate to how much sell-off occurs in equities. If retail traders need this much money, which is short for M2M, they will sell this much bullion. But if they need this much money to pay their M2M, they will sell this much bullion. So how do I know how much is the shortfall in every trader's pocket? Number one, let's go back to the MTF. When MTF starts to fall, when these leading counters which have the heaviest borrowings against which traders have leveraged themselves, when they start to fall, you will know that unwinding has started to occur. And then I will of course update you in this video about when you can expect bullion to bottom out. It will all be data driven. Let us not conjecture, guess, or put any kind of emotional decision making. It should all be a very, very scientific process so that we can go home as winners. Is the long-term story in Bullion still intact? I would say so, yes. Which is why I made these videos telling you how to buy pure bullion at honest to God prices, how to check purity electronically rather than the rub test on a stone, how not to get cheated, etc. Because I want you to buy physical bullion. There is no point in incurring cost of carry and cost of funds in basically embroiling yourself into futures and options, getting hyper about mark to market losses, etc., and then surrendering your positions. There's actually no point in working for a financer when you can basically buy a smaller amount, buy it in physical and or ETF if you so desire, but don't pay carry cost or monthly or bi-monthly cost of carry. It is eating into your profits. So anybody who's sitting on deliveries, looking beyond 2025, highly patient and disciplined investor, hey, the long-term story is still very, very intact. Friends, if there are any more ideas that I need to share with you, I will happily do so on my social media accounts. Do connect with me there. Before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment segment, do let me know what you think about my video and how I can help you become an even better trader. I thank you for being with me in this video. Till we meet in my next, this is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Let's all prepare to go home by being on the right side of the market and staying ahead of the crowds. Take care. Bye-bye.